All right, what's up, guys? I hope you're doing well. James here from jamesforesight.com, and today we're going to go over 3 different things that a CBDC needs in order for it to be adopted by consumers, right? And for that specifically, we're going to head over to the screen share to go straight to a discussion paper done by a collaboration of different central banks throughout the world. This includes for examples, for some of them would be the Bank of Canada, Bank of England, the Federal Reserve Board, or the Board of Governors, I should say, of the Federal Reserve, the Bank of Japan, and even though it's not a central bank, but the BIS, the Bank of International Settlements, and this paper itself can be found on their website specifically. So strategies for adoption would have to be tailored to each individual economy because their economic structures and payment landscapes are different. And we talked about this somewhat more in depth in previous videos. How every jurisdiction is different. There's so many different factors that could change. There's so many different um, legal structures and things like that, to where it really kind of depends on the individual country and kind of how their entire system is set up, right? And so, with that being said, a central bank digital currency would be different for each individual person, right? Sorry. Um, Phone calls. But anyways, so also the best way to have this a central bank digital currency to be adopted would be to have it fulfill some unmet needs from users, right? So to have a consumer, it would have to fill a need of a consumer that isn't already fulfilled in the system. And that's probably one of the reasons why one of the main selling points for this is financial inclusion. Um, Whether or not that is a significant problem, not the topic of this video, but that is a way that is a need that they're proposing that a central bank digital currency would fulfill, right? And so other ways would be it would achieve network effects, just like that, just like those of the US dollar in terms of like the euro dollar system, and also how it kind of permeates throughout the shadow banking system. There's that. And also, it'd be easiest if it can already be implemented with the existing technology and infrastructure that we already have, right? And so instead of everyone having to either buy or have to learn how to use a new type of technology, whether that be kind of like, say, like a taser for crypto, in terms of a digital wallet that you can use for crypto and stuff like that. Not everyone knows how to use those things. So to have everyone need to use it just to transact would be a major hump, right? And so having a central bank digital currency basically able to just work with what we already have, whether that be like an actual physical card, like a tap to pay, or maybe it's kind of just like a digital signature in your phone, maybe a QR code, I don't know, just examples that come off the top of my head, things like that, right? To where it can just work, right? Because in the end, consumers are going to take the path of least resistance, right? So, these new non-financial market players, to continue on with the paper, have shown a strong understanding of what users need from their payments products and what conditions are necessary to facilitate adoption. Central banks would need to take into account this evolving context if they choose to launch a CBDC. So one of the things that they talk about um, throughout these papers is the need for kind of continuous innovation, and that's part of the reason why they're talking about having a multi-tier system, to where it's sort of, you have the core infrastructure of the currency itself, right? And that's the central bank's problem, right? The core rule book, whatever. How exactly is this currency going to be structured? Is it interest bearing, non-interest bearing, things like that, right? Talking about the currency itself, but like the actual services that are needed for a currency. So like prepayment things, um, like checking your account, whatever. During payment things like how is it going to transact across ledgers, and post payment things like customer service, which can kind of also be during the payment, and things like billing, things like that, right? That'll most likely be outsourced because especially things like customer service, to where in the case of the United States, the Federal Reserve doesn't exactly have experience with customer service to that extent, to where they're not having to, it's not like you walk into some store like Walmart or Lowe's or Home Depot, whatever, and you have a customer service desk that anyone can walk up to and have help, right? So there we go. So, and this is where we get into the three needs, right? So, in order to have a CBDC be adopted, it needs to fulfill unmet user needs. We kind of alluded to this before. Achieve network effects. Already talked about this before. And it also does not require all users to buy new devices. So, also something we've talked about before, right? So, it needs to follow that path of least resistance, right? And so, in terms of fulfilling unmet user needs, a CBDC would have to offer in digital form the unique advantages of central bank money, settlement finality, liquidity, and integrity. This is something they talk about frequently throughout these papers. Basically, with the central bank digital currency being a liability of the central bank, they call it basically the safest form of money because the central bank can just create it. There is no counterparty risk really with you not being able to withdraw it, because because your counterparty is able to literally just print, especially in this case of a central bank digital currency, they could just create it to fulfill their obligations, right? Achieving network effects for the second one. So this includes like payment mechanisms, and they may be more successfully adopted in a one-sided market, which would be like a person-to-person payment market. So a CBDC design might therefore choose to emphasize peer-to-peer, kind of like some cryptos, functionality in order to facilitate adoption, right? So basically having network effects. And I did this kind of easily kind of slides into the topic of privacy, which I did a video specific on, which I'll link the entire playlist for all of the central bank digital currency videos and all of the videos related to that into the actual description, so you can find all those if you need, right? And so also, for the last one, it does not require all users to buy new devices. The technology thing, it's just easier for everyone to use what they already have, right? They're already familiar with it and so on, right? So to continue, central bank digital currency payments might potentially be enabled through the existing infrastructures and networks, keeping the current network and infrastructure. This approach might lead to near instant adoption by the majority of merchants using systems already integrated with their existing accounting and point of sale system. However, this approach would also build a reliance on existing networks and infrastructure with potential negative impacts on resilience and competition. This is one of the cost benefit analyses that they have been talking about throughout these papers. It basically they create a parallel but separate infrastructure and network for a central bank digital currency. So basically, if the quote unquote traditional financial system were to crash or have some falter in some way, even if it's just a specific segment, the central bank digital currency version would still be open. And so people would still be able to transfer currency in that route, right? Or also, on the other hand, having them using the same system, basically just stacking another mode of value, I guess, onto the same system, right? Which would be better in terms of easier to implement, but you have that risk of now if that system itself starts to have problems, your CBDC also starts to have problems. And so there's quite a few other examples that they've learned from past adoption for payment services. And so this is where I was quite surprised to see some of these actually. So they give examples of Swiss. It was a mobile phone app launched in 2012 for Sweden. And then there's M-Pesa, Mobile Pay, and Vips, looking like it was from Denmark and Norway, it seems, respectively. And they seem to be based on short-term message or short message service, SMS technology like texting. The platforms provide the unbanked population access to basic banking-like services, similar to Swiss. Key success factors appears to be that if it offered a service in a market where no convenient digital alternative existed and that onboarding was easy, right? People are going to take the path of least resistance, right? And so those were some examples above. If you want to look into them more specifically, they leave sources and such with actual links that you can click on. And of course, I'll actually link this PDF into the description, like always, so you can find your stuff if you want to look more into it, right? And so there's also some that didn't pay out, which it looks like, for example, Paybox, which was in Germany in 2000. And so it said insufficient advantages over the established system. So it wasn't good enough to basically overcome the humps relative to the current system they already had. So high costs for users and a lack of cooperation to engage customer use meant that adoption never managed to achieve a sustainable level, right? So essentially working against its success were, and it gives 3 examples. So consumers not valuing its unique selling point, which was anonymous payments. And this is also with respect to something called DigiCash from the early 1900s. I'm sorry, 1990s, not that old. And 2, banks hesitant to enable the service for their account holders as existing card-based electronic payments were lucrative. And 3, a lack of partnerships with existing customer bases, right? And there's a few other examples. It looks like there's 9 in total of ones that they used. So if you want to look more into each one of those specifically, I'd highly recommend it. Stuff like this is pretty interesting. There's also ones, looks like, I misspoke earlier. So Denmark was mobile pay, Norway was VIPS, and then M-Peso was in Kenya, which kind of surprised a little bit about. But anyways, yeah. So that being said, so 3 major things to repeat, and I guess the main takeaway for a central bank digital currency to be adopted by consumers in general is it has to fulfill needs that they have but aren't already met. It has to achieve network effects in order to function in a systematic way. And then it also needs to be easy to implement in terms of technology so people don't have to go out and get new devices and have to learn how to use new devices, and because that's just a hump you don't want to deal with, right? So anyways, we're going to leave that there. So I hope you guys have a good night, and I will see you on the next one.